Hey, well, thank you everybody for joining us today. I'm going to quickly go through the outlook for corn and soybeans in particular, but I will talk just briefly about what's going on in cotton and wheat markets because there are some ramifications there that are interesting moving forward. When we look at what's going on in markets, there's obviously a couple of prevailing themes that are really affecting where prices are and where they're potentially heading. So when we end up looking at kind of key factors on the crop side of things, the first one that I'll point out is just the 2021 U.S. yields. It's one of those ones where there's still a fair amount of yield uncertainty when we look at what's going on, particularly in the Northern Plains. But I'll kind of dive into kind of the regional differences there because there are some really big regional differences. The other one that's always lingering in the background, I'm not going to dwell on it, but China's demand and imports is going to be very critical to where price direction goes this winter. They've started buying some additional product, which is obviously a positive for our prices, but they can be very fickle in terms of purchasing behavior, and creates a level of uncertainty in the markets. Then we have our counterparts down in South America that are entering their planting season. And they're no different than producers in the U.S. When they see the prices where they're at, there's going to be an incentive to put more into the ground and try to maximize that planted acreage. Looking a little further out, I think 2021 and 2022 in particular is going to be very critical for the RFS. I think there's some potential issues there that will need to be addressed, and there's a huge amount of uncertainty as which direction this administration is going to end up taking that. Livestock and poultry demand is also going to be important. I'll leave that more to Andrew. And then when we look at kind of that overproduction theme, that's one that I think we are going to maybe not get into necessarily this fall, but definitely 22, 23, as people start to produce under these high price environments. I think we do run that risk. The one that I do want to kind of point out to me and Andrew were talking about a little bit before everybody got on, but profitability is the goal, not the price. We are going to have some higher input costs this winter. And so again, if we do see a pullback or even a moderate pullback in price, that's really going to adversely affect profitability. So when we go to corn, I'm not going to dwell too much on the supply and demand side of things, but I do want to just kind of give a basic overview. And again, we look globally, we've had 4 consecutive years of reduced ending stocks, which is a positive for price. It provides support for prices where we're at right now. We are anticipating, or the USDA is projecting, a moderate uptick, but again, I think a lot of that's going to depend on where we see some of these yields come in and how the Brazilian and the US corn harvests end up occurring. When we look specifically to the US, we still are under a very tight stock set of stock circumstances, with 1.24 billion bushels projected to be left over after this marketing year. And so again, that's really important when we form our price expectations for marketing the 2021 crop and when we look to opportunities in 2022. I did mention exports. And again, obviously, we have to take some of these export numbers with a grain of salt. When we had the trade disruption with China back in 2018, 2019, and then we did see a bounce back last year, very strong export sales. The phase 1 trade agreement is still in effect, which should be through the 2021 year. The question is what happens after that? And when you do notice that there is an estimate of U.S. exports to fall for corn, that is more of a function of the supply, the contracting supply, rather than it is demand. I think there's still very strong global demand out there for corn. And again, we've recaptured some of that export share that we lost during the trade war with China. Focus of what I want to talk about today is kind of what's going on from a weather standpoint. I'm just throwing up kind of the U.S. corn production map and then the latest U.S. drought monitor. And again, we have very different growing conditions in the eastern versus the western corn belt. And this will have some ramifications for basis and logistics for this fall and winter as we market the crop. And so when we kind of dive into this, the USDA on August 16th came out with their first yield estimates. And I just kind of wanted to give everybody an indication of where we were in terms of what they rated for the corn crop. Good to excellent nationally was 62% and projected yield of 174.6 bushels per acre. Tennessee was 79% and 173 bushels per acre. But you really do see the differences when we look at the Dakotas versus the eastern corn belt states, Illinois, Indiana, and Ohio. North Dakota, just 20% good decks, and obviously severely impacted by the drought with a yield of about 106. When you look at Illinois, Indiana, and Ohio, they all have the opportunity to potentially have record or near record yields because their conditions have been much better. So again, it's really challenging trying to pull together that national yield and where that's going to be, just based on how very different it is on the different sides of that corn belt. And so again, I suspect that as we continue to get some more estimates coming through as we get closer to harvest, that we can see some volatility in the markets because we will have a chance to end up having either higher or lower yields depending on where you're at. When you look at the Dakotas, you know, a rain up there probably isn't going to do much good. It's a little late in the season for that, but again, where these yield estimates end up coming out is really going to be critical to what the production is and what we see in terms of prices. When we look at December corn futures, we are still in an uptrend. We had a lot of volatility back in April and July, but if you look at the long-term uptrend that was started back in August of 2020, we have maintained that, and we're still you know, around that between that $5.50 and $6 range. So again, some very positive or very good positives in terms of prices as we enter the harvest season. When we look at basis, you know, obviously, I think one of the biggest advantages we have in Tennessee for people marketing corn is basis, particularly if you have storage so that you can access it at different times of years. These charts here kind of show, you know, we haven't had the basis levels that we've had this year since back in 2012. It is important to point out that these basis charts here are for elevators and barge points and do not have the influence of poultry and feed mills, some of the other terminal markets, where obviously in our state we get some incredibly high basis offerings on a need basis from those sources. So again, it just kind of picks up the differences between where we're at right now and the 5-year average. When we look at projecting price forward, I'm not going to go into the math behind this, but essentially this just kind of gives an indication of, based on where the U.S. corn stocks to use ratio is and what our projected national marketing year average price would be. And so the national marketing average price would be about $4.25 to $6. And I'll translate that at the end here into kind of what an expected range would be for Tennessee cash prices. But the big takeaway from this one is, you know, there is a substantial amount of support based on what we're seeing on a supply and demand side of things to maintain prices at the current levels, if not potentially increase them a little bit, depending on where some of these supply numbers come in. You'll notice that 2020 number is a fair ways off of the projection, and we have to think back to what that season looked like. If you remember 2020, that first half of that season, we had absolutely horrific prices. We were down in the threes, right? And so that was a really strange year because we didn't see that rally until later on, where we pushed these prices up, and that wasn't reflected in the numbers. When we look at profitability, you know, I think there's going to be some pretty good profits out there. You know, I'm not saying that there's not issues out there, but if you look at, I used a $710 cost of production estimate. If you look at 170 bushels and 650, that's $395 an acre. And so again, there's going to be a huge variation in here, but crunching these numbers and seeing where individual farms are on a profitability level, I think is really important moving into the marketing season. See where we can end up having some real profitable opportunities on the corn side of things. So I think for a lot of producers across Tennessee, this is going to be a good year in terms of corn returns. Switch it up to soybeans, we see kind of a similar supply and demand trend where we have ended up seeing global supplies decrease. Obviously, soybeans were adversely affected by the trade war with China as well. But one thing that a lot of people, you know, last year Brazil harvested a record soybean crop. And so again, even with that as the backdrop, we did see, you know, a decrease in global supply. So the question I always have is, down South America, what will 2021 bring? I definitely think there's a bias to planting more acreage down there, but how that growing season progresses is really going to be important as we enter, you know, our winter and their planting season, or our fall and their planting season. When you look at the U.S., you know, they're still projecting, the USDA is still projecting that we're going to be basically functionally out of of ending stocks. 150 million bushels is what they're projected for the end of this marketing year, which does provide some restrictions potentially in the export markets. You'll see that the export estimates for soybeans is estimated to be down. But a lot of that, again, is a function of this very tight ending stock number. We have very strong domestic crush and strong exports, but if we don't have the beans, it's going to be challenging to improve upon last year's export numbers. And so we see that in the soybean export numbers, where again we see that U.S. share in gray there going from 2.26 billion down to 2.06. That's again not really a function of strong demand. That's just a function of constricted supplies. And so when we look where we're at, obviously it's us and Brazil that are providing most of the global soybeans. I do want to show this map again, the drought monitor one, because there are some slight differences when you compare the soybean production map and the drought map. And you'll see more of a bias on the soybean sides to the northern and the western side of the corn belt when you're looking at soybean production. So again, I think that really is going to support some very strong soybean prices as we enter the harvest period, because that's where we're kind of at that epicenter of the drought up here, where we've got a fair amount of soybean acres. And again, that's reflected in the crop progress. I'm not usually a huge proponent of looking at crop progress numbers. I think there can be some issues with looking at some of that data, but I think this time it really does kind of paint the story of what we're really looking at in terms of production and how uncertain it is. Just because when we look at the Dakotas and Minnesota, obviously they're going to be bringing down the national yield, where you have Iowa or Ohio, Illinois, and Indiana that are going to be bringing it up, and then Tennessee, 49 bushels per acre is what they're projecting. So we're going to be right around the national average. It'll be interesting to see. I think that we could see some revisions up to that number in Tennessee, because I think conditions are pretty good. When we look at prices out there, right between $13 and $14 on the November contract for 2021, and we're creeping up again. We still have that upward trend when you look at even from the 2020 time period up into 2021 November contract. We still do have that upward contract. And so again, the one that I'm looking for is as a key support level is that $13 range. I think if we can maintain it above there, we do have the chance to end up seeing some very, very positive developments as we enter the winter season. We look at soybean basis again, and we've got a strong positive basis. It's different for corn because we don't have the major end users or terminal producer markets in soybeans that we do in corn. So most of our soybeans are either going to go down the river or out of state down to Alabama to crush facilities. And so again, we do have a very strong basis, which just adds to that price that we showed on the futures market there. We're looking at projected price, market year average somewhere between $10.25 and $14. So again, very supportive of prices near where they are right now, potentially higher if we do end up having a pullback on the production side. Because the big one that's really, really driving this, both on the corn and soybean side, is demand is there. We have really strong global demand. We have really strong domestic demand, and that's really going to drive it. And so, supply is kind of the key unknown right now for a lot of our commodities. And so again, when we look at profitability, I've got a 580 cost of production in here. This is going to be huge variation both for corn and soybeans across the state. So you do really have to plug in your own cost of production number to see where we're potentially looking at in terms of profitability. But we do have kind of, that 13 to 14.25 range is kind of the price range we're looking at this fall. Obviously, it'll depend on what was pre-priced and the pricing arrangements producers made. And then, we will have people that will have substantially higher yields. Now, yield and cost of production are typically going to be extremely correlated. But again, it's something where we do want to map out where we are from a profitability standpoint. Real quickly on cotton and wheat. I know there's not a ton of cotton people out, but I did put in 2 slides on cotton. We are way behind on our cotton crop, about 2.5 to 3 weeks behind normal progress. I think that could be yield limiting. It makes us definitely more susceptible to harvest weather, particularly if we do have a very active hurricane season. For people that really want to delve into the supply and demand numbers. Tyson out in Jackson is putting on the cotton tour September 1st. They do a great program out there. We'll be talking supply and demand and price expectations. But when we look at where we're at on the December contract, we've got a real strong chance that we're going to hit $1 cotton sometime this winter. It's been incredibly strong recently, although there is some caution to that. I've been talking with some of my colleagues around the Southeast region, and anytime you get cotton over 95 cents, you do run the risk of demand erosion with synthetic fibers. And so that's one that if we do stay kind of north of 95 cents for extended periods, we could see a pullback in demand, particularly overseas. And so again, when we look at where cotton prices are projected from a marketing year standpoint, again, still some very strong projections for the national marketing year average price. Still a lot of variability left in there for all commodities, just because we don't really have a great production estimate right now. Switch to wheat, because I know there's going to be people that are going to be very interested in planting wheat this fall when we've got prices going towards 750. There's some real indications that we're going to have some strong wheat prices. We've got major production concerns in the northern plains with the spring wheat crop that extends all the way up into the Canadian prairie provinces. And so we're expecting much lower production out of that region. There's some issues in Russia in addition that will definitely end up coming into play, because they are a major player in the export market. So there is, some real potential for us to see some improvements in wheat prices, even from where we're at, based on what we've seen so far in the growing season. One that I would encourage people to consider if they are going to plant wheat is get some downside protection. And out of the money put options work well for something like that, where it's not going to handcuff you on the production side, and does allow you to increase or participate in market price increases. So again, I think it's something where it is warranted, if you are going to plant the crop, to at least consider getting a little bit of price protection on the extreme downside. And the other one too that I pulled some statistics out, and there's really only been 5 times where the July wheat contract or the nearby contract has been over $7 in the last 20 years. So again, it gives you an idea of where we're sustaining prices is probably not going to be there in the long term. So again, just protecting against that if you are going to plant out to 2022, because the challenge with wheat, as we all know, is it's produced on every continent except for Antarctica and in both hemispheres. So the ability to have a production rebound is always prevalent, because it's always growing at some point in the globe. Now there are different wheat classes, and we could get into that, but again, if you're talking just in general, it is something where there is the ability to produce rapidly on that. We look at stocks to use, again, at 525 to 710. So when we look at how that kind of translates across commodities into Tennessee cash price, that'd be the far column on the right. We have the harvest futures for 2021 as at August 17th. So that'd be the December contract for corn, November for soybeans, December for cotton. Then I have the WASDE projection from August 12th, I believe, is when the report was released. And that just gives you the national marketing year average price. And then the harvest futures for 2022. And then the projected Tennessee cash range. The reason why we have such a huge range in there, you see $2 on corn and $2.50 on soybeans, 10 cents on cotton, and then wheat 650 to 775 is just, there is a tremendous amount of uncertainty when you look at the production side of things, and then also with the on the demand side, what China is going to do in terms of exports does probably have a pretty strong influence on where these prices are going to go as we move through the harvest period and into the winter marketing season. When we look at kind of marketing considerations, obviously it depends on what people have priced heading into harvest as to what the strategy is. One of the ones that I find kind of challenging right now is a short hedge, and a lot of that's just because of the margining and liquidity requirements. We've seen the volatility and the movements that does take a lot of liquidity or a very understanding banker to make sure that you're positioned in there. I think options is a great way to remove some of the downside risk and still allow futures market increases and the ability to take advantage of Tennessee's very strong basis. Storage works well with that as well. But the out of the money put options, I think, is a great risk management tool that can take a fair amount of the downside risk for a reasonably small premium. And then identifying, terminal markets for producers in county regions to increase price premiums, I think, is always a good thing. Kind of looking around, seeing who is paying what during the harvest year. And again, this really benefits if you have both either bin storage or you maybe have temporary storage through a bagging system. And the last one that I will just kind of close, it's not necessarily too early to start looking at the 2022 crop pricing. Does it make sense to take some price risk off the table? Again, I wouldn't get too aggressive, but I would start monitoring what's going on the futures side of things, because as mentioned at the start of the presentation, I think we're in for some real high input prices. So if we can cover off some of our input prices by securing at least a price floor in the futures market through an out of the money put option, I think that is something that is worthwhile to consider as we look at the 2022 crops. When we look at some of the price offerings out there, I just pulled a few that are out of the money for each commodity, just for consideration. And the one that I will point out, and I'll use corn as the example here, is at $4.50 and 20 cents. $4.30 is probably lower than most people would want. But that is the futures price floor. If you ended up using that strategy, you could still take advantage of a strong basis, right? And so again, just considering options for 2022. Like I said, I wouldn't get too aggressive, but looking at where we're at right now and maybe pulling some of that risk off the table, I think is warranted. Because all of a sudden, if we have cost of production that's up 20 to 35%, there's a lot more risk there that we do probably want to end up having at least a floor on some of our price offerings. So